to you, Julia. Just a broad-based sort of calming thematic to start with. Let's talk about central bank moves to really just calm those troubled waters.
Carson, it looks like it's finally going to be a good day on the Aussie share market, and that follows on 4 days of losses. We did see the US stock market up by 1% overnight, and part of that was some of the good economic data coming through. We saw US house prices up by 12%, but also a bit of short-term optimism over China as officials came out to calm investors that they won't be letting things get out of control over there. So it does look like it's going to be a good day around the region. We saw commodity prices recovering, copper prices recovering from that 3-year low that we saw. Oil prices also slightly higher, although we did see iron ore prices down by 2.2% to 114 US a tonne. So all in all, it does look like it's going to be a good one for the Aussie share market. This, of course, comes as we're doing the countdown to the end of financial year. Only 3 sessions left until the financial year is at an end. And the Aussie market at the moment tracking for a 14% gain. Of course, for the year to date, the calendar year to date, we're on more shaky ground with only a rise of 0.2%. But today's gains should add to the increase in both the yearly as well as the financial year gains. Just having a look at the market map, you can see that it's pretty much green across the board. It looks like some strong support coming through from the big 4 banks as well as from the miners today. So it does look like green on screen today, and finally following what's been a roller coaster ride for the market.
Speaking of miners, talk Rio did well in London, and it's likely to do similarly here. Selling the Mozambique coal business, that, at least according to reports. Are you getting a sense on price in this environment?
If we have a look, there are some media reports out, especially the Australian, talking about a part or a wholesale of the Mozambique coal assets. Now, remembering that Rio Tinto didn't acquire these assets too long ago. It was part of the Riversdale takeover back in 2011, where they acquired it for $4.2 billion. But of course, with coal prices falling, we've seen massive write-downs for this project. And earlier this year, we actually saw Rio Tinto writing down $3 billion off this project. Now that's 70% of the value that it paid. So it has been a problem. We have seen falling coal prices. And if we have a look at Rio Tinto and what they've been saying that over the next 12 months, one of the key priorities is to get their balance sheet in shape. And there are a number of ways that they're looking to do this. But the number one way is through asset sales. So they're looking at asset sales, they're looking at cost out, and really what this means for investors over the next 12 months is that we probably won't see an increase in the cash being given back by Rio Tinto in the form of a dividend or capital management, because really it's focusing on getting its own house in order. If we have a look at Rio Tinto, we know that they've earmarked certain assets for sale. Initially, they had earmarked the diamonds business as well as Pacific Aluminium, but it does look like their diamond business now off the chopping block. Rio Tinto looks like they're looking to sell assets, but not at fire sale prices, so looking to retain assets if they cannot get a good price. Of course, we know that coal has been a difficult story with falling prices and falling demand. If we have a look, we've also seen Peabody coming out to say that they're looking at cutting 450 contractors throughout their Queensland as well as their New South Wales operations. So this is a space in which we are seeing cost outs and asset sales being the order of the day, and looks like Rio Tinto may be considering a sale of its Mozambique asset.
Let's talk about the gold space. Just coming into us on Dow Jones Newswise, UBS with a fresh view on Perseus. It's cut the target price there by 19% down to 130 a piece, but it's retained its buy rating. More broadly, investment houses taking views around the price in the round, and what are you getting a sense of there?
I guess it helps just to have a look at where the gold price has been, and this is the gold price of the last 5 years, and it's this pain that we've seen from this fall from 1800 to around about just over 1200 US an ounce in gold prices. Now it's very difficult to find any investment bank that hasn't cut its gold forecast. We've seen Morgan Stanley, we've seen Credit Suisse, Goldman Sachs, UBS, Deutsche Bank, we've seen SocGen all coming out with cuts to their gold forecast for this year as well as next year in 2020. 2015 and beyond over the last couple of weeks. I guess the key reason is the Fed's move and the rise that we are seeing in real rates. So the end of quantitative easing is a key reason, and that's caused a mass exodus in terms of exchange traded product holdings as well, which is at the lowest since June 2010. Now, gold has been oversold, so it is probably due in for a short-term bounce as well. One of the largest commodity buyers in the world, Jim Rogers, says that he's been buying, but if we have a look at some of the bearish forecasts in the market, I guess the most bearish for this year is SocGen. They're predicting 1,200 US an ounce by the end of the year, and for 2014 the most bearish is Goldman Sachs. They're predicting 1,040 US an ounce by the end of next year. So looking at gold, it has been a steep decline. It is probably due in for a short-term bounce, but the investment houses are certainly quite negative on gold at the moment.
All right, well, we will